Next, we're going to talk about alimony. Alimony is kind of in a state of transition. So for settlements dated December 31st, 2018 or earlier, there will be a deduction for AGI for the payer of alimony. And then the person that's receiving that alimony must include that in gross income. But if an agreement is reached or modified after December 31st of 2018, then there's no deduction, but there's no income included. Now, for the alimony agreements that are under this deduction income paradigm, there are some guidelines to ensure that property settlements are disguised as tax-deductible alimony. And remember that even when we get to 2019 or after, we still are going to see a lot of alimony deductions and alimony income inclusions, because this agreement could be 10 years old. As long as it was signed before December 31st, 2018, and there have been no changes, you will continue to deduct and include an income. Now, if you have a client who is thinking about modifying an alimony agreement, then it's important that you get professional guidance on how to structure that to keep the deduction income inclusion if that's what you want. You just want to make sure that you don't have any unintended tax consequences if in fact your client goes back for a modification after December 31st of 2018. Next, we'll talk about imputed interest. The concept of imputed interest was used to discourage large gifts disguised as loans. Grandpa says, hey, grandson, I'm going to loan you $100,000. Pay me back when you can. When you can never happens, and eventually it is a loan that's forgiven by the estate. So in order to discourage this, the IRS says that any loan over $10,000 is subject to interest. Now, if the loan really does have an interest rate that is at least a minimum interest rate, and that is known as the applicable federal rate. Those rates are published by the IRS each month, and of course they go up and down depending on the broader interest rate picture. Then you don't have to impute interest. You're good. But if you're not, so let's say your loan is charging 0.5% and it's a long-term loan and the AFR is 2%, you're not charging the correct amount of interest, so you are subject to the imputed interest rules, and that means imputed interest must be recognized by the lender. Now, it doesn't matter whether the lender receives cash or any kind of compensation, they do have to pick up that income. And so that, I guess, again, would be an exception to that cash basis of accounting, but this is one of those exceptions to the exception. A few other items of taxable income, unearned income to keep in mind: gambling winnings, jury duty pay, trustee fees, and hobby income. I guess you could argue that some of those are potentially earned income, but these are not generally subject to self-employment tax, which is what we think of, or payroll taxes, when we think of earned income. A couple words about jury duty pay. So quite often I'll get clients who say that they received mileage, which is more often than not more than the $10 or $15 that Pima County pays their jurors. Mileage is an expense reimbursement and it is not taxable. If your client is lucky enough to actually get parking reimbursement, which we don't in Pima County, but if they did, that would not be taxable. That's an expense reimbursement. But the $10, $15, whatever your county pays or whatever that jurisdiction pays, technically that is taxable income. If you have to give that to your employer in order to get your salary for while you were serving as a juror, then you don't have to pick up jury duty pay. And again, another reminder, I have not seen a 1099 for a long, long time for jury duty pay. Typically, that's because in order to issue a 1099, the amount needs to be $600, and that would have to be one heck of a long trial. But just as a reminder, just because it is not reported on a tax document to the IRS does not mean it's not required to be reported in income. So if a juror does not have to repay an employer the amount he or she receives for service in the jury, that should be included in income. A few things that are excludable from income. I often get the question about gifts and inheritances because people kind of hear things about gift tax and inheritance tax. Sometimes they call it the death tax. Well, as we learned last week, the gift, estate, and transfer tax system is a different system of taxation from income tax, and we're talking about income tax here. There may be gift tax, there may be inheritance tax, but there is never income tax on the transfer of a gift or an inheritance to a beneficiary, to an heir. So I can say with confidence, if you receive a gift, if you receive an inheritance, you do not put that on your income tax return. Now, if you receive as an inheritance a retirement plan account, and you take money out of that retirement plan account wrapper, there will be income tax consequences. But merely the transfer of the account from the decedent to you, the heir, does not trigger income tax. And for that gift and inheritance tax, again, separate system, which is not the focus of our class. But when there is gift tax, if there is inheritance taxes, estate tax, that is paid by the estate or by the donor. It is not paid by the donee or the heir. So it's a pretty safe to say you do not pay taxes on gifts, you do not pay taxes on inheritance when you're receiving. Scholarships are non-taxable, child support is non-taxable, and that has not changed. So pre-2019, post-2018, child support is not taxable. Also, the gain on the sale of a personal residence within certain limits is not taxable, and we'll talk more about that in another week. So to summarize today's lesson, you learned about community property and innocent spouse, equitable relief provisions, the various types of investment income, tax treatment of various investment transactions, and tax attributes of special purpose accounts such as Roth IRAs, education accounts, and annuities.